Point. Thanks for joining us on Power Lunch. This is Bloomberg Quint and I'm Ira Dougal. Let's get you the headlines this Monday afternoon. Indian markets start the second half of 2018 on a somber note amid muted global sentiment as crude prices remain elevated. India's manufacturing activity clocks its highest growth in 6 months, strong growth in domestic and export orders. Tata Steel is among the top Nifty gainers after it inks a 50-50 joint venture with ThyssenKrupp in Europe. The German steel giant's investors continue to oppose the deal. Automakers cruise through June. All players report double-digit sales growth. Bunch of conversations coming up on Power Lunch today. We'll talk to ICRA's Karthik Srinivasan on whether LIC's Rescue Act will actually help IDBI Bank and how much. We'll also talk about the strong PMI numbers. What are they indicating for the broader economy? Upasna Bharadwaj of Kotak Mahindra Bank joins us. All right, but first, as always, let's take a look at how the markets are faring. Darshan Mehta is here with us. Afternoon, Darshan.
Good afternoon, Ira. And as it was seen in the first half of the year that, weakness was seen in the mid-cap and small-cap. Now it's being reflected in the benchmark indices. So look at the cut, a 100-point cut on the Nifty. All the gains of a strong first day of the July series has been negated with this cut. The Nifty Bank is down 250 points. The Sensex is down almost 0.8%. And it seems to get worse for the mid-cap and small cap end of the market. So if you're looking at it, 1.2% cut on the mid cap and almost 1.5% cut on the small cap. Global cues also coming in weak. The Dow futures are down in trade. Now look at the weakness in some of the sectors. Despite Tata Steel's announcement that came out, the Nifty Metal is the top loser as far as the index is concerned. It's down 3% in trade, and Tata Steel also has slipped into the negative. Real estate continues to bleed. It's down almost another 2% after a drop of 20% this financial year. And PSU banking space, which had corrected significantly, continues to be rather weak. It's down almost 2%. The only sector which is managing to hold on is the IT sector. Look at the Nifty contribution and you can see the pain that is coming in. The only positive contributors are pretty much some of the counters like Infosys, IndusInd Bank, Asian Paints and Bajaj Auto. Minuscule amount of contribution, but look at the heavyweights that have dragged the Nifty down. The HDFC twins have actually combined got in a 25-point cut on the Nifty. Reliance adds in another 10 points and another 10 points added in from ITC. So these are the heavyweights, high weighted stocks which are falling in trade, and that has pulled the Nifty down with it itself. What is gainer? Some of the counters which have gained today include the likes of IDBI Bank after a sharp sell-off over the past few days. There is traction that's happening. Amara Raja Batteries has managed to recover after hitting much record lows. Bajaj Auto came out with strong set of numbers, that's doing well. And on the tire space, you have Balkrishna Industries, which is doing well. But more on the negative side, counters like Adani Enterprises and TV18 are down anywhere between 8 to 10% in trades. Heavy selling seen on the counters. JSPL from the metal pack is the worst performing as far as the FNO metal stocks are concerned. And Nalco is seeing significant amount of selling. So overall, it seems like an extremely weak trading session today.
All right, thanks so much for that, Darshan. That's the broader market, as Darshan also mentioned. IDBI Bank is well bucking the trend. Small gains on the bank after IRDA approved a likely investment by LIC in it. LIC could be allowed to increase its stake in IDBI Bank to almost 51%. That is what Bloomberg Quint reported on Friday. Now, much has been said about whether LIC should be bailing out IDBI Bank, but what does this mean for the bank, which incidentally has the highest levels of bad loans across the industry? To discuss that, we are joined by Karthik Srinivasan, Group Head of Financial Sector Ratings at ICRA. Karthik, very good afternoon to you. Thanks so much for joining us. My first question to you is that I was reading the note that ICRA had put out in May, when they were rating certain instruments by IDBI Bank, and it looked like, a bank which is already weak was set to weaken further. So I guess my first question is that was a bailout, and we'll talk about the form of the bailout, but was a bailout for IDBI inevitable in some ways?
In some way, it's not only IDBI, but most of the public sector banks did require a sizable capital infusion for them to come out of the capital stress that they currently are in. with resolutions, the pace of resolutions remaining slow. We've had one or two large resolutions on the NCLT in the last month and a half, but at an overall level, the resolution pace still remains quite lower to what one would have anticipated. In that context, the only way that the banks could improve their position at the earliest would be a sizable capital infusion. So in that context, if you would want to call that as a bailout, then that's what is probably required for a lot of these entities.
But IDBI in particular, Karthik, I mean, so I think 27% was the reported or thereabouts was the reported NPA in the March quarter. Your note talks about the fact that actual level of stressed assets is higher in the 30s perhaps. Your note also talks about the fact that internal capital generation remains under pressure, so you will need some additional infusion. Do those aspects get sort of resolved if LIC were to put in money, assuming that this is a fresh issue of shares and the capital comes to IDBI Bank and doesn't go to the government?
Okay, to put things in a perspective, our estimate is in case IDBI Bank was to meet the regulatory capital requirements, including capital conservation buffer, our estimate was they would require a capital infusion of about 11 to 12,000 crores. So that's the kind of number that one is talking about. And if one, again, so that's the bare minimum that they would require to stay afloat as far as regulatory capital is concerned for FY19. And this also takes into account that the bank is unlikely to be making any operating profits in the current year. This year, again, thanks to higher credit provisions, the bank is likely to report losses as well. From LIC's point of view, if one assumes that the entire infusion to increase its stake from about 8.5 odd, factoring in the government recap which came in May for them, if you were to include that, then for LIC to do an entire stake raise to 51% by way of capital infusion into the bank, the quantum could be in excess of 20,000 odd crores.
Okay. Do you think that IDBI needs that kind of capital over the next 2 years? Again, I come back to your rating note on instruments, so not asking you to go outside of that. But that seemed to suggest that weakness will continue in FY18 and perhaps in FY19 and perhaps the year after as well for IDBI Bank.
That's right. So our own estimates, the bank would require about 11 to 12,000 crores as per our estimates for FY19. Beyond that, it would be dependent on what sort of resolutions happen on these large delinquent accounts over the course of the year. So if we were to assume sizable recoveries, then possibly the capital requirement may come down. But clearly FY19 is not going to be the end. They would at least require further capital for next year at least, before you assume that the operating profits start kicking in and the capital requirement possibly goes down beyond that. But FY19 and in all likelihood in FY20, the entity would require capital.
Karthik,
this is assuming that the other plans on. Yeah.
No, sorry, go on. I interrupted you.
No. This is we also factoring in when one says 11-12,000 crores of capital, it means in all forms, whether it is. We're talking in terms of tier 1 requirement for IDBI. So part of that might also be met by divestment of non-core assets and all. So we need to see how that mix really pans out.
Okay. Karthik, is there any change in how IDBI will be rated if the majority shareholding is LIC and not Government of India? I know LIC is quasi-sovereign or considered quasi-sovereign, but if that government support is not sort of built into the ratings, does that change the view?
It is a bit really early to comment for a simple reason. We are still unsure as to how the money would come in. Is part of that going to go to the government, or is it entirely going to come into the bank? What's the quantum? Per se, LIC, as you said, is a quasi-government in any case. So the benefit or the advantage of a quasi-government would be factored in. But at this stage, it's a bit too premature to comment on the trajectory of the ratings.
Okay. Karthik, at a slightly more sort of macro level, what have you seen as the actual business impact of weakness in IDBI? They've been degrowing their corporate books, so I assume some of their market share would also come off. They're going into retail, which would impact perhaps their margins. Can you give us a sense of how you see this impacting the outlook for IDBI as an entity?
Yeah, clearly with the constraints on capital, what one has been doing is shrinking the balance sheet, getting out of corporate accounts and going into retail. That does give some benefit on the capital front, but still clearly a lot more has to be done in terms of generating top line. So the improvement would really be visible only when you are in a position to increase your top line, and that is at least as we speak is going to take time unless there is any big bang kind of an income which comes, whether it is treasury or it is sale of non-core assets. So if one was to keep that aside for a top line to improve and support the operating profits of the bank, it's going to take some time.
Much
the direction is right that you're looking at retail assets, but then
Okay, you're basically saying that retail is a good direction, but it has to actually come to a point where it can fructify into real gains. Last question, Karthik, this is IDBI, but also broader. I think your note mentioned that you don't expect IDBI to come out of the PCA regime at least until March 19. I would assume that is the kind of view that you're taking on all banks under the PCA framework, that it will take at least 12 months for them to actually emerge from it, if at all?
That's right. I mean, at most of the cases, the breach or you're failing on the PCA filter largely on the asset quality front and the profitability front, in addition to capital. And in some of the cases, we really don't see that changing at least over FY19. So we won't be surprised if most of the banks continue to remain in the PCA bucket based on FY19 numbers as well.
All right, Karthik, thanks so much for joining us and giving us a sense of what this could mean for IDBI. As Karthik was also saying, there is still uncertainty on how exactly this capital is going to be infused, over what period of time, what is the structure of the investment that LIC is going to make into IDBI, and of course the big thing, will the Reserve Bank of India actually clear this? So lots of unanswered question even from an IDBI perspective. From an LIC perspective, how does LIC stand to gain from this deal if it does go through? We spoke to former LIC Chairman SP Mathur, who says that 5 to 7 years is too little a time for LIC to make any use of IDBI, either their branch network to sell insurance products or otherwise. Listen into a bit of that conversation.
The distribution strength of IDBI Bank is much smaller, that it takes time to develop such collaborative approach, develop competencies, develop skills to distribute insurance products sitting in a branch environment. So my feeling is there should have been a minimum window of 10 years. Because if it is 5 to 7 years, the pressure starts building up from 4th, 5th year, third, 4th year, you start doing something. And if the capital market environment, the bank problems which run widely across all banks, not just IDBI Bank, are not solved, there are going to be complications and a potential lower or less return for LIC policyholders.
All right, we haven't heard the last on that deal, but let's move on for now. Tata Steel and ThyssenKrupp have sealed their European joint venture on Saturday, creating the second largest steelmaker in Europe. While it's still a 50-50 JV, the fine print shows that ThyssenKrupp actually has an upper hand in the new entity. Nikki Mirchandani joining us with the details. Nikki, first, what all gets transferred to the joint venture?
I'm going to start off with the debt, where Tata Steel is going to be transferring 2.5 billion euros of debt in the joint venture. ThyssenKrupp will be transferring around 4 billion euros in the joint venture, out of which 3.6 billion euros will be from pension liabilities. Also, we're expecting an annual synergies in the range of around 400 to 500 million euros. This is expected to be realized in the span of next 2 to 3 years after the joint venture has been formed. And also, Tata Steel and ThyssenKrupp combine in the joint venture entity. At no given point of time, the shareholding should be less than 50% for the span of next 6 years.
Okay, and where does ThyssenKrupp get an advantage, Nikki?
Sure. So it has a reduced economic interest of Tata Steel actually works in the favor of ThyssenKrupp, or rather the other way around, where ThyssenKrupp's stake in joint venture at the time of the potential IPO would stand at 55% as compared to 50% currently. This is mainly on account of Tata Steel issuing warrants which could be at the time of IPO be converted into equity, because of which there will be a shareholding increase for ThyssenKrupp, and also ThyssenKrupp will have an exclusivity on deciding the timing of such IPO. The press release also reads that since the signing of the MOU, the difference performance development of ThyssenKrupp Steel Europe and Tata Steel Europe has led to valuation gap between the two entities. The definitive agreement includes a proper compensation of this valuation gap.
Okay, and just a quick one on whether the synergies have been revised lower as well. Just detail that out.
Sure. Just 2 points that I'd like to make here is about the synergies being lower than the one that have been guided upon in September 2017. Post due diligence, the higher band of guided synergies has been revised down by 100 million euros to 400 to 500 as compared to the range guided in the 400 to 600 million euros in September 2017. Also, there seems to be some ambiguity in sense of the timeline structure being guided by Tata Steel. It earlier said that it's expected, the JV is expected to see the light of the day by end of 2018. However, ThyssenKrupp has maintained a timeline guideline of around 12 to 18 months. Separately, Tata Steel in its con call also said that they expect the regulatory approvals to be in advanced stage by 2018, by the end of 2018.
All right, thanks so much for that, Nikki. Meanwhile, major ThyssenKrupp investors are still unhappy with the joint venture. Sevian Capital voted against the deal and has gone on record to criticize it. Sources tell Bloomberg News that Elliott Capital too is underwhelmed with the final contours of the deal. Bloomberg News, Christine Harvey joins us from our studios in Dubai with more. Christine, what's the bone of contention still? Christine, if you can hear me, I'm going to try that again. Just trying to understand what is the main concern for ThyssenKrupp's investors. All right, I think we've lost that line. Now we will try and move on. But that deal, an important one for Tata, got closed over the weekend. So let's move on to Indigo, which is already dealing with Pratt & Whitney's engine troubles, may now have to wait longer to get delivery of its new aircraft. We will bring in PR Sanjay to join us on that in a minute. All right, apologies. We don't have PR Sanjay either today. Let's go on to IPOs. The first Indian railway company to debut on the exchanges, RITES, listed at 2.7% premium to its issue price. We caught up with the chairman, Rajiv Mehrotra, to get a sense of the company's order book and revenue mix. Listen in.
Order book as of 31st March was 4,800, and it is a continuous process. You know, you keep getting orders, you keep delivering orders. Net addition in 18 was about 1,700 crores over last year. Consulting would predominantly remain 50 to 60% revenue portion. But we have added turnkey business segment also, where we are doing turnkey execution of railway projects, whether it is doubling or third line or electrification or new workshops for railways. So this is again a very fast increasing business line. This could actually come up as number 2 in terms of revenue composition, then followed by exports, local leasing and power related businesses. Turnkey projects typically would be 1 to 3 years execution, and we already have started working on all these projects. We got an invite meanwhile from the Indian Railway Station Development Corporation for joining them for 25% equity, which they are going to enhance as 1,000 crore. We have conveyed in principle approval. We are discussing with them the business plan, the shareholders participation agreement, the management structure, etc. Once we are able to get an acceptable level of comfort with such investments, we will go ahead with that. But I'm optimistic about this sector going to go in a business risk return profile.
Fine Organics also listed on the exchanges today. The specialty chemical maker debuted at a 4% premium to its issue price. In a conversation with Bloomberg Quint earlier today, the company's CEO Jayant Shah spoke about its new facility being set up in Patalganga. Listen in.
We are very strong in emulsifiers.
Okay.
And this premixes particular product segment which we have joined hands with a company called Zealandia, where we are putting up the plant in Patalganga, which will get operationalized next month. We wanted to bring in this range of product to the Indian market, and which we started almost 10 years back. We have been importing those products and we have been selling it and developing the market within India. And now we have decided to put up the facility dedicated for 10,000 tons, which will add a significant revenue to the current parent company, the issuer company. 2018 has been a good year, which we will be soon disclosing our the numbers. Very soon we'll be doing it. However, having said this, with the existing product profile and the range of products we cater and the new product range which is adding up, I continue to ensure my EBITDA is minimum in the range of 18 to 20. That is very, very consistent.
All right, let's get back to the story on Indigo. Indigo, which is already dealing with Pratt & Whitney engine troubles, may now have to wait longer to get delivery of its new aircraft. PR Sanjay of Bloomberg News joins us with more details. Sanjay, the British engine maker doesn't seem to have found a fix yet?
No, I think the story is continuing, and Airbus will be delivering at least 30 to 40 fewer airplanes to entire airlines across the world. This would mean two things for Airbus. They were planning to ramp up their capacity. Whatever delay was there in the 2017, they want to increase it, to ramp up in this year, which will again, they will miss the deadline because of the same reason, because if Pratt & Whitney is not able to fix its engine problem. So which will also have the second part of it is Indigo, India's largest airline by passenger carrier, will also face problems. And you know that a game-changing proposition for Indigo was always A320 Neo, and they were forced to lease out a lot of A320 CEOs to tide over the crisis. Now they will have to bear with this cost, and if at all Pratt & Whitney come up with a new engine design, and they will if they can catch up with this delayed schedule, then Airbus could will have some space saving measures. But till now, Indigo and other airlines which are hugely pinning hopes on A320 Neos, which can save actually 10 to 15% fuel savings at this cost, will be in trouble.
All right, Sanjay, thanks so much for that. Let's slip into a quick break. Coming up on the other side, India's manufacturing activity clocks its highest growth in 6 months. We talk to Upasna Bharadwaj of Kotak Mahindra Bank.
Sir, please believe me, I am in this business for the last 12 years. Okay, I'll wait for your call. Thank you so much.
They still don't know you after all these years?
क्या करें? पहचान ही नहीं है.
Simple solution hai. List on the stock exchange. With listing comes recognition. Investors get interested in you. And funding happens.
Come on, yaar. I'm not big enough to list. Chal, let's leave.
There's a stock exchange exclusively for your kind of company. NSE Merge. It's the right platform for your business.
Really?
Yeah.
My kind of company?
Exactly. Get listed, get recognized. अरे भाई, हीरे की असली परख जौहरी को ही तो होती है. चल.
NSE Merge. साथ हमारा, सफलता आपकी. The SME Growth Platform from India's largest stock exchange.
promise of GST was a bold one. Has it delivered? Join BQ as we take a deep dive into the year gone by, from our vantage point to yours. Watch the fine print GST special all week only on Bloomberg Quint.
Welcome back. You're watching Power Lunch. Let's take a look at the headlines. Indian markets start the second half of 2018 on a somber note, muted global sentiment as crude prices remain elevated. India's manufacturing activity clocks its highest growth in 6 months. Anil Agarwal makes a fresh offer to buy out all other investors in Vedanta Resources. Automakers cruise through June. All players report double-digit sales growth. All right, let's dip back into the markets to see what stocks are moving. Agam Vakil joining us with the movers. Agam.
Well, Ira, if it wasn't for the drop of 1% on the benchmark indices, one would say that it's been a very quiet day of trade, especially when you consider the turnovers right now. But when it comes to the benchmarks, looking at a cut of around 1%, along with the bank nifty, which is bearing down on the broader markets. Let's take a look at the turnovers too. And again, when it comes to the NSE cash market, well, that's at around 17,000 crores. Not too much to speak for when it comes to the NSE F&O turnovers either, at little less than 3,000, or rather 3,30,000 crores. Now, there's one sector which isn't doing well, and that's the metal sector. Metal index is down by as much as 3% in today's day of trade, and these losses are led by the weakness that we've seen in Hindalco. Hindalco is down by nearly 4% as we see. In fact, well over 4% is the kind of hit that we're seeing on Hindalco. On the gaining end, we do have very few stocks which are up and about and advancing, and among them we do have something like a Bajaj Auto, which is up and about because of the good volumes that we've seen for the month gone by. We have some gains coming in Asian Paints, but on the losing end, other than Hindalco, we have weakness in NTPC, Bharti Airtel and Adani Ports. So on the whole, markets are not looking very good as of now, and in fact testing the levels around 10,600 when it comes to the Nifty.
All right, Agam, thanks so much for that. That's daily trade. 2018 so far has actually been a mellow year for Indian equities, especially when compared to the exuberance witnessed last year. While some sectors like IT and consumer goods have done better than others, heavyweights like PSU banks and realty have had a tough year. Darshan's here to wrap up all the action for the first 6 months of 2018. Darshan.
Yeah, so basically I think the weak trend continues into July also. The index is down 100 points, but let's take a look at what's happened. The Nifty is up almost 1.5% in trade currently, if you're looking at what happened from January 1st to right now. And look at the stocks that have moved. These are actually the stocks like TCS, which is the largest market cap company in the country, and all of them are expensive stocks, be it a Kotak Bank or a Bajaj Finance or a TCS or an HUL. So basically money is moving into the HDFC twins. So money is moving into the select stocks which have high percent weight on the weightage on the Nifty, and that's where it's moving. Look at the stocks which have fallen in trade. Basically the low weightage stocks on the Nifty, low valuation stocks, and then they've been down anywhere between 17 to 40%. Now the Nifty is up 1.7%. Now take a look at the mid cap and take a look at the small cap, and you can see the pain. The mid cap index is down almost 15%. No doubt some of the counters have moved, and they are basically in the mid cap IT space. But look at the cuts that have come in counters like Vakrangi, which is down 85%, PC Jewellers, Suzlon, NBCC, which was trading at record highs, is now at a 52-week low. Engineers India, which all these counters were buzzing. Now the mid cap index is down 15%. Now let's take a look at the small cap index, and you will see the pain. The small cap index is down 22%. No doubt some of the counters that have moved include counters like HEG and Graphite and a lot of mid cap and small cap IT names. But the pain in some of the frontline counters like Jet Airways, Balrampur Chini, BEML, you had other counters also which moved in trade. So basically there is significant amount of pain, some of the counters falling even 75%. So basically you can see that it's only high value stocks which have high weightages on the Nifty which are moving in trade, but apart from it there is significant pain. Now what's gained? IT is up 20%, the FMCG index is down up 8%, the Sensex is up 4%, the Nifty Bank and Nifty have managed to rally, but only two sectors have had significant amount of outperformance over the benchmark indices. But look at the pain in some of the sectors like the mid cap, which is down 15%, small cap down 22%, real estate and PSU banks down anywhere between 22 to 25%. So selling pressure is clearly there on the markets at this point of time. What has gained? The Nifty is up almost 180 points. Majority of the gains coming in from the high beta counters and the high weightage counters. So the HDFC twins contributed significantly, TCS contributed, and HUL contributed significantly. And the counters which led to the fall, very few of them, basically Maruti Suzuki has a high valuation, but apart from it, the others are trading at much lower valuations. Now, in terms of how the fund flows have panned out and volatility in the market, this stat gives an indication. We have selected companies in market cap in excess of 500 crores. Only 4 of them have doubled in trade in the YTD. 18 of them have given returns in from 50% to 100%, and 136 have given positive returns, but less than 25%. But this is where it gets alarming. Out of the entire list, 413 stocks have given negative returns anywhere between 0% to 25%. There are 343 stocks which have fallen anywhere between 25 to 50%, and 50 stocks have fallen over 50% in trade. And you can see the fund flows also, and that will give an indication. FIs have been continuous sellers in the market. They last bought, and for the past 3 months they have been selling, and it's only the domestic liquidity that is keeping the market afloat. And now we're seeing that selling pressure has finally come out in the benchmark indices also.
All right, Darshan, thanks so much for that. Moving on, manufacturing activity in India has gathered pace. The Nikkei India manufacturing PMI improved in June to 53.1 from 51.2. Let me go across to Upasna Bharadwaj to understand what to make of this data. She is economist with Kotak Mahindra Bank. Upasna, good afternoon. Thanks so much for taking our call. What did you make of the data? Seemed like there was strength on various counts, domestic orders and export orders.
Yes, I think if you look at the indices across the board, I think it has been a broad-based improvement that we have been witnessing. If you look at the demand side parameters, then basically both domestic as well as external side factors are suggesting an improvement. The new orders, the export orders, all of them seem to be suggesting well for the future production. So clearly, this has broken the trend of a declining PMI reading that was seen for, most of the first half of calendar year. Now, I think the other aspect which needs to be noted is that most of the price indicators, the input prices and the output prices, that too have suggested a significant upward pressure. So clearly, if we were to look at the weightages, then yes, output prices have risen, which is expected to show up further in the consumer price index. Along with that, the input price increase has been much more than the output price increase. So to begin with, the first step, it could squeeze the corporate margins. And the second step, it has to eventually pass on to the output prices. So we will continue to see this pass-through happen over the next few months as domestic demand remains firm. And hence, the rising inflationary pressures that we are seeing will continue to pose an upside risk on the price trajectory as we go ahead. So yes, it is an upward move. We are seeing that persistence of higher input prices over the output prices, and that does pose an inflationary risk going ahead.
Upasna, in some ways consistent with what we expect from the economy this year, right? If just you go by the MPC's forecast, a strengthening economy coming together with higher inflation just based on demand, even if you take out things like currency pressure or MSP pressure, but the basic message is that, right? Stronger economy, yes, but higher inflation.
Yes, absolutely. So I think largely the next 1 or 2 readings more, we know that the inflation is expected to peak out. And then after that, we see some moderation in inflation. Having said that, of course, the sequential momentum remains intact because domestic demand side pressures are firming up. So while that is there, I think one more point that we need to highlight is that, we are in any case expecting that one more quarter down the line, the base effect, which is actually supporting the growth, that is going to fade off. The last 2 years, the GST impact, the demon impact, all of that will be done with. And then we'll need to watch out for exactly how the growth indicators are. Right now, we are kind of getting masked because of the previous impact of favorable base effect. And hence, I think somewhere we will start seeing a moderation in the activity. The right now run-up to activity that we're seeing, economic activity, that may not really sustain. The growth momentum may not sustain in the second half of the year as much. Having said that, yes, there is, at this point in time, there is an upward move in the cyclical upward move in the growth momentum, and at the same time, inflationary pressures remain intact.
All right, Upasna, just one last question. So if you look at the PMI numbers across Asia that came in today, very diverse trends and probably not easy to get a sense of what's happening to the Asian economy, particularly given all these trade tensions, etc. Because I think China, Indonesia, Philippines saw a decline, Malaysia, Vietnam, India saw an improvement. So very diverse trends across the region.
Absolutely. I think globally what's happening is there is a lot of uncertainty with regard to trade issues, the trade tensions. And that is likely to pan out and, in fact, reflect across the PMIs even, as we go forward. The next 3 to 6 months will be, definitely getting marred because of the trade tensions globally. And hence, I think we will be seeing some further slowdown in economic activity globally because of this. At least the PMIs will be suggesting of that. And we will have to see how that translates into real economic activity. But as of now, I think this divergence is clearly one of the reasons is trade tensions, and that is likely to continue in the next few months as well.
All right, Upasna, thank you so much for that quick call. Appreciate you taking the time to speak with us. That's the economy. Now, linking into that strong domestic demand story is the June numbers for the automakers. June's turned out to be another good month for these companies, with all of them posting healthy double-digit growth last month. What's also encouraging is the sharp rise in passenger vehicle sales for players like Tata Motors. Yash Upadhyay joins us with the details. Yash.
Well, thanks for that, Ira. So, Maruti Suzuki, the largest automaker, that saw its sales increase by 36% in the month of June. Now, they sold close to 1.5 lakh units, which is significantly higher than our estimate of 1.3 lakh units. Now, this strong outperformance, this was led primarily by a strong demand in its compact vehicle segment, which includes the likes of Swift, Desire, Baleno, and others. Also, we are looking at Mahindra and Mahindra. Now, their auto division, that reported a 26% growth in sales, with the number coming in at about 45,000 units, in line with our estimate. Now, their passenger vehicles business, that had an okay month, but the commercial vehicles and export business, that has posted a strong growth in June. Tata Motors had another fantastic month. Their volumes grew by 54% on a year-on-year basis to some 57,000 units. And not only has the commercial vehicle segment done well, but also their passenger vehicles business, that has posted a strong 64% growth, led by a strong demand across the board for most of its models. They recently launched the Nexon automatic variant, which is also being received very positively. That apart, we're looking at Ashok Leyland. Their sales, they have grown by about 28% in the month of June to 15,800 to nearly 15,800 units, which is again higher than our estimate of about 14,000. Now, this was led primarily by a strong demand in their light commercial vehicles business, which grew by 45%. The tractor makers, they are not too far behind. M&M Agri business, that reported a strong 22% growth in volumes, primarily by a strong demand in the domestic market. Similarly, for Escort, their overall volumes, they grew by about 73%. As far as the two-wheeler makers are concerned, Bajaj Auto clocked their highest monthly sales in over sales growth in over 8 years. They reported a 65% growth in volumes, led by their domestic motorcycle business, which saw a robust 65% growth, while their commercial vehicle business, that also reported their highest ever monthly sales. As far as Royal Enfield is concerned, they reported some 74,500 units in the month of June, which is a respectable 18% growth on a year-on-year basis, but came in slightly below our estimate of 75,500. What's working for them is their premium end bikes, which is the 350cc and up models, which reported a 29% growth, along with a healthy demand in their export market. Back to you.
All right, thanks so much for that. Anil Agarwal wants full control over Vedanta Resources. Vulcan Investments PLC, Agarwal's holding company, has offered to buy out all other investors in the mining giant. If successful, it will lead to Vedanta being delisted from the London Stock Exchange. Swansea Alfonso of Bloomberg News joins us. Swansea, firstly, what have they offered, and then why are they doing this?
Right. So they are looking to buy Vulcan Investments, which is run by a trust that Anil Agarwal owns, is looking to buy the remaining 33% stake in Vedanta Resources at a valuation of about $1 billion. They have flagged like the simplification of a group as one of the reasons for this move, and also the increased maturity in the Indian markets, which is where they have listed subsidiary as well. But this move actually comes after a lot of political unrest that you have seen arising from its closure of its smelter in India and some other operations as well. So, I mean, it could be also some investors also flagging it could be a part of a larger strategic move, you know, because they also, Volcan also has an investment in Anglo-American as well.
Okay. Yeah. So essentially, it looks like a simplification, also perhaps lesser regulatory compliance if they're listed here and not there.
Yes. So initially they had listed in London because of the deeper financial markets so that they could have access to more cash. But looking at all the environmental and other problems that they are facing, this could be a move to kind of, you know, reduce their exposure in the market.
Sonsi, thanks so much for that. India's power crisis is characterized by idling capacity on the one hand and unmet power demand on the other. The government is seeking to resolve this in a multi-pronged fashion, from creating a power bad bank to auctioning power purchase agreements. While power producers are in support of this approach, some sector experts are calling for a bolder time-bound solution. Listen into a conversation that Menka Doshi had with a panel of stakeholders earlier today.
We tried a pilot of 2,500 megawatt. Of course, DISCOMs showed a lot of interest, so we have a little bigger demand than 2,500. But in the first round, offers only for 2,200 megawatt have come, basically from the people who would be having some sure coal linkage available to them, and some capacities which are not linked with PPAs. So, I mean, as it is a pilot, we expect it to go through quickly, and there is definitely demand from the state governments in the medium time frame. They would not like additional liabilities to be created in the terms of fixed cost and all. So we designed a model which may not be very much favorable to the generators, but I am calling it as a beginning. If it succeeds, then we'll modify the model, make it more balanced, and then come out with more such bids in the days to come.
All right, could you take us through more such bids? Because I understand for this first pilot, the price bids are to be opened on the 6th of July, which is at the end of this week. So do you have more auctions already in the pipeline? Because as I read somewhere that there is about 5,000 megawatts of PPA demand, as you put it, from the DISCOMs.
Yeah, we would do that. I mean, we haven't, see, the demand from DISCOMs is there, and after success of this round, we will we'll have to modify the bidding system a little bit. As I said, it is a little more in favor of DISCOMs than generators. So we'll have to balance it out and do a regular kind of thing. This was a pilot. So we'll assess the further demand. And as you rightly said, we have more demand today than the bids we have got. But why we have not got more bids, many generators have raised the issues with us. And the process has started. So we have gone ahead with the existing system, and we will modify it and then make it as a regular system. This is a pilot we are doing.
The government seems to have floated a few other ideas as well. Something called the Samadhan scheme, the Parivartan scheme, which is REC-led. And the last I read, there was an India Ratings report which suggested that the government's also discussing the possibility of creating a national distribution company. Of all of these, can you tell me which one is likely to be a reality and what the potential architecture of that scheme could be at this point in time?
See, the Parivartan scheme has been brought out by SBI, and they have singled out about 10-11 assets which are operational assets, where with the little bit of restructuring, the assets will turn around. And they have already gone for the assessment of the sustainable debt, and once that ratings are available, then these assets can be put on auction and with a restructured debt. And if, as I said, these are operational assets with the PPAs and all, there are certain other problems which can be solved with the debt restructuring. So we expect that a set of assets which are operational can be resolved by Samadhan scheme. Now, Parivartan scheme is basically an asset management company which REC has suggested, and we have been discussing this model with the Ministry of Finance. It basically says that house the assets for some time till the further demand comes and pick this thing. So assets which do not have PPAs as of now and are stressed can wait for some time and wait for the demand to pick up, and then those can be turned around and sold in the market. So that's a scheme on which REC has made certain suggestions. We have been discussing with finance, and we expect that once some issues get resolved, because setting up of this type of asset company needs certain relaxation from the RBI. So once the model is acceptable to all lenders, we will, our REC would be moving that and seeking the relaxation. So once that happens, then some of the assets which are the other than ones which can be solved with Samadhan could be moving into this basket.
There is talk of a national distribution company that the government is considering in order to do what the state discoms are not able to do, given their level of indebtedness or their level of losses. That you want to create a national distribution company. This is something I read in an India Ratings report, and I want to confirm if this is the thought process within the central government.
Suggestions have come from various stakeholders for forming a company like that. But it needs to be further discussed what could be the outline of this company under the Electricity Act, how would it function as a distribution company. Presently we have two PSUs which are basically doing distribution strengthening and funding, REC and PFC. And most of the government schemes are also being routed through these companies, and the government schemes like Uday have been implemented with their assistance to strengthen, to build capacity and to sustain the discoms which are not performing up to the mark. The suggestions are from, as I said, from different stakeholders have come, which are under examination of the government.
Vinayak, you've heard or you already know of the various solutions that are being worked on, the timelines within which they're being worked on. My question to you is this: do they fix the underlying problems, which range from the lack of coal or the inability to be able to sort of resource coal in the right fashion, or the lack of PPAs, or the falling price of power, to the timelines that will start kicking in thanks to RBI's circular? Do you believe these fix the problems or only fix the symptoms?
Okay, I'm going to step back a little and make 2 points. One, it is for more than 5 years, half a decade, that I have been saying in my discussions with people like you on channels, in writing articles for the financial press, that it is the distribution sector. The distribution sector is the tail that wags the power sector dog. And it is the travails of the distribution sector, if removed, can see this stressed assets, the generation side buzzing again. So the problem is not of some scheme X or scheme Y or scheme Z that will affect some 2,500 megawatts or 5,000 megawatts of generating capacity or discussion with RBI. The time for that is over. We had the last 5 years to do all of that. But the problem is not today's. The size of the problem, as you yourself said, is humongous. Depending on which estimate you take, it is 30,000 megawatts to 70,000 megawatts of stressed generating capacity in a situation of extreme. It's an extremely paradoxical situation that here you have a country which is crying out for power. The last statistic that I know is that the average power cut in urban India on the Urja website is 7 hours. 7 hours, some X minutes, some 7 minutes more than last year. So power cuts have increased in urban India. And for rural India, it is anybody's guess how many hours they are. So you've got a sector that is crying out for energy, and you've got capacity that is unable to sell the power. What is the problem? The problem is the distribution sector. And with this size of the problem, tinkering around with experiments and what shall I say, pilots of 2,500 megawatts, the time for that is over. I am one of those, as mentioned, I am one of those stakeholders who for a long time have been advocating a national power distribution company as the real sledgehammer that is required to hit this sector and revive it. The transformation of discoms, the tinkering around with stressed assets is a medium-term phenomenon. The country cannot wait. I strongly advocate that the government immediately set up an architecture for a national power distribution company. It is the only sector where the central government is not present. It is present in fuels, it's present in generation, it's present in transmission. It is surprising that with all the stress in the distribution sector, the central government is still making up its mind as to what impact it can have on the distribution sector. I strongly advocate a national power distribution company, which after all the state discoms are done with their PPAs, all the balance surplus capacity can be picked up. The question is, where can you sell it? Do whatever is required in the Electricity Act to solve the problem, sell it to all the utilities which are owned by the central government, starting with railways, moving on to PSUs like SAIL and various others. Army, ports, the central government has a huge number of establishments where it is the purchaser of power. So I'm going to stop here to say now, Summary, it is the distribution sector that is the problem. We cannot wait for the medium and long term for this sector to turn around and start demanding power. The situation requires urgent action. Okay. The size of the problem is humongous, and it requires a matching solution. The matching solution is a national power distribution company that immediately picks up the balanced power generating capacity available with power plants over and above the PPA signed with the state discoms.
Mr. Khurana, can you give me the quantum of power capacity or stress power projects that currently face no PPA or have no PPA and have no coal? Because it seems to us the writing is on the wall. For those, the banks will have to take substantial write-offs. What is the amount there?
Yes, you have about 15 to 17 gigawatt of those projects which have neither coal nor PPAs.
Okay, so
then
these,
you have
these
about
cannot
7
be
gigawatt
resolved.
of projects.
These cannot be resolved in any way. Nobody is going to buy these. Nobody is going to buy these. Nobody is interested in these. The only way these can be resolved is if they go through some sort of IBC process. But even then, there will be no buyer. Is that your contention?
No. My contention is, as Mr. Bhalla rightly said, you had a bid of 2,500 megawatt, of which you got the offer for 2,200. This bid came without the coal. Now there is a clear-cut provision in Shakti which provides for giving coal linkage to an aggregator. My suggestion to is next bid should come with coal so that those projects can also bid. This will widen the participation and get the bids.
All right, power, a key focus this year. Moving on, it's exactly a year since the implementation of the goods and services tax. The new regime was expected to hurt the MSME sector the most, with system upgrades and the requirement for greater compliance. But 1 year down the line, at least some MSME players are actually happy. A centralized system means less paperwork, and an input tax credit system has also stopped the cascading effect of various taxes. Payaswini Upadhyay spoke to such entrepreneurs in our special coverage, GST at 1.
India's over 7 crore micro, small and medium enterprises or MSMEs were predicted to be the hardest hit when GST was implemented. A year later, not all of them are as pessimistic. Businesses say while the new indirect tax regime took some time getting used to, the benefits of GST cannot be ignored either. New rates, change in tax administration process, overhaul of return filing procedure, technology upgrade. Preparing for the goods and services tax regime was no mean task for small businesses. Chandrakant Salunke, president of the SME Development Chamber of India, says that while there were initial hiccups, GST has helped the ease of doing business objective of the government and has nudged small businesses to improve their business practices.
SMEs doesn't have a manpower to face the problems or to visit the various offices, VAT office or the GST office, or earlier the many taxes were there. ICRA was there. So a lot of issues was happening faced by SME sector, and now last 1 year I observed that many SMEs smoothly they are running their business. After GST, SME sector developed their turnover. They started showing official business. When I go to any bank or when I meet any investor asks me what is your turnover. So now my turnover is increasing. Automatically all transactions are coming on my official paper. So therefore this is the best advantage for SME sector to showcase their turnover, showcase the strength of their company. So this is the best increasing valuation of the company. And we can say the attractive system for an investor's point of view.
For Al-Aziz Plastics, manufacturers of electrical accessories, PVC pipes, fittings, water distribution products and more, preparing early helped make a smooth transition. Several state and central taxes getting subsumed under GST had a positive impact on business, says Uday Adhikari, the founder of the company.
We had to first pay the central excise, then we had to pay the VAT, and then the transportation and the octroi. Octroi is a big headache, especially when it came to the cities, wherever the octrois are there. So now you don't have to wait for the octrois, you don't have to pay the octroi, you don't have to corrupt the people, you don't have to avoid the octroi. So it has been very, very, very good.
GM Warke, founder of High Media Laboratories, agrees. Based in Mumbai, the company manufactures culture media for microbiology with application in pharma, food and agriculture industry. The new indirect tax regime also meant lesser forms to fill, Warke points out.
There multiple taxation was there. So instead of multiple taxation, only one single tax is introduced, that is GST. And because of that one, whatever the hurdles the industry was facing, starting from the plant level, excise people now, as our unit is export oriented, export product, we do the exportation. So every time we have to call the excise inspector for the signing our documentation. So that hurdle has gone now. Second thing, when our truck start from Nasik to Mumbai, then again we have to pay the octroi or taxation or N form, and that is also avoided. That is the second part. Third part, so naturally the goods are coming from factory to airport. The time is reduced because there is no hurdle, and that is one major benefit what we have got. Second thing, no problem of the excise, whatever the problem we used to face for the excise, for the VAT system, or again now farm particularly as we have to deal with the domestic market. In domestic market, each and every state was imposed the farm, because you cannot have the entry into that state unless you have got the concessional farm. Then only you can make the entry. So that is also avoided. And now what problem we used to face, that is now completely eliminated now.
Okay.
And that way all the means for export, for the domestic market we have benefited, and naturally my other industry also they must be benefit like that.
Okay, and would you say that the corruption level has come down to a certain extent? Yes,
corruption level has come down drastically in the sense, now for suppose now if you go to call any person at our industry or any person visiting our industry for one way or some other reason, we have to entertain him, and that entertainment is now reduced. So naturally, as such, indirectly that corruption has gone.
But not all aspects of GST have been a joyride. There have been speed bumps too. Lack of clarity on product codes, transition goods, and increased working capital requirements, to be precise.
The transition from the VAT and excise regime to GST was a painful one, especially for goods that were manufactured prior to July 1st, Warke recalls, and lack of clarity on HSN codes prescribed by the government for various products continues to be a problem.
Generally, we sell our product through our majority of distributors, and distributors who are not ready to take stock the material, and for quarter 1 and quarter 2, we are a great loss because the dealer were not ready to purchase any material. The reason was there because they were also not aware whether they can able to get their stock, whatever the stock they are holding, whether they are going to get the return of that in their product or not.
Okay, when you mean that the distributors were not taking or accepting the material from you,
yes,
why was there the reluctance on their part?
The reason is that they were not aware what charges we have to charge, because it was a confusion. And now even the department or the GST department, they are not clarified what exactly they should do, and whatever the stock is lying with them, what we should do about whether they are going to get the output of that one, because whatever tax they have paid earlier, because government has declared that whatever the material you have purchased will give the benefit of that tax. So they were not very clear, and that's why there was confusion with the dealer, and so they have totally stopped to purchase the products.
Okay, so this was basically the confusion with regards to the transitional stock.
Transitional, yes.
Okay, all right. Tell me some of the areas where you are still facing any problems in the context of GST?
At the moment, because particularly as far as the GST is concerned, because HSN code numbers are very defined. Because as international code GST HSN code numbers are 8 digits, while still we are having only 3 to 4 digits, and that's why the HSN code number, it is based, GST is based on the HSN code number, and unless the HSN code numbers are clear, then only the user or the customer, they are ready to pay the taxation. And even the department is still not aware how much tax for particular item, how much it should be charged. So that is the HSN number are not clear. So it is my urge for the government, actually the authority, that we have to bring to uniformity as far the HSN code numbers are concerned.
But they did put out a list. Was that not an exhaustive list?
That is not still complete.
Supplying products to research institutes has also been a sticky issue.
For research institute, we have to pay the 5% GST. Okay. And there we have to take the declaration from the institute that this product is only going to be used for the research purpose. And if we don't get that, type of declaration, okay, or whatever the declaration is given, and at the time of assessment, if we are not going to convince to the authority, then in that case also we have to pay the full tax.
You are supplying your material to a research institute,
yes.
Okay, and they are supposed to give you a declaration
yes.
that they are going to use this material for research purposes.
Purpose only.
Okay.
So, and if they will not, if suppose they will not give, they fail to give that declaration, okay, we already supplied the material, we will supply we will give the declaration afterwards. We have to trust them, we have to believe, because they are a regular customer. And if they will not give that declaration in time or till the assessment, so naturally we have to pay the full tax.
But when you are delivering that material to them, is it not obvious that that declaration will come in at that time?
Many people, they don't give.
Can you hold back the supply in that case?
No, we cannot. See, one thing is the research to say that it is my work is very urgent. Now my research work is held up. Okay. In that, and second thing, they are regular parties. So we cannot hold them material also.
For Adhikari, the biggest problem has been the increased working capital requirement.
What happens when we sell? We get paid almost after 90 days or 120 days, or maybe at times, after that and things like that. And you got to pay your tax immediately, maybe on the 20th of the next month. So the whole working capital requirement has gone up, and which is definitely pinching.
Did it translate into you telling your customers or signing or renewing your contracts in a fashion that they pay you earlier?
Well, we request them, but they don't.
And then there is the never-ending ask of rationalization of rates. All three voices that you just heard also said that the government should reduce the rates further to help make their products competitive. They also made another important point, that the loudest voices against GST are of those who were used to doing business in cash and could evade taxes. Those who want to do a clean business, they said, are broadly happy with GST. In Mumbai, Paiswini Upadhyay.
That's a wrap on this edition of Power Lunch. Thanks so much for watching. Countdown is up next.